Were there any positives?
Not a lot of positives on the market. In fact, if you have a look across the top 50 stocks, not one of those managed gains. In the top 100 stocks, we only saw 2 stocks making gains. And it's the largest fall that we've seen since the 7th of June 2010. In the last 2 years, there's been only 16 times where we've seen a fall of more than 2% on the Australian share market. And if we have a look at those 16 times that we've fallen more than 2%, usually the next day means a bounce back. In fact, all but 4 out of the 16 times we've seen a fall of that magnitude, we've seen a bounce back the next day.
Hurrah.
So traders do seem to be a bit pessimistic. Of course, they are reacting on the numbers, but markets do tend to overreact. But yesterday I did say that the market had reached the top end of that downward channel that we've been on, and that will come back to target the bottom end of that channel. So the mark that everyone is watching at the moment is 4,582 points. That's the low that we've seen in this correction so far, which has seen a correction of 7.9% over a period of around about 8 weeks for the Australian market. But altogether, if we have a look at corrections, it hasn't been too severe. Just this February, we saw a correction of more than 9% on the Australian share market. And last year, April, May, that correction there was a correction of almost 17% on the Australian share market. So we have certainly seen moves like this in the last couple of years, but the market really reacting to that economic data out overnight.
A short, soft patch, but that it will likely be the dominant theme for equity markets?
I think the markets are looking at, and have been looking for a while, at a slowing down in global activity. The ISM manufacturing numbers have seen a slowing trend, and the markets were only looking for confirmation that this trend is continuing, and we certainly saw that this week. Confirmation from the Eurozone, where we did see the PMI numbers coming out at a 7-month low, from the UK, which has seen the lowest amount of growth since September 2009, from China with a reading of 52, once again confirming a slowing trend, and then of course the US ISM manufacturing numbers, which were a complete shocker. The markets were always expecting a bad number because the regional surveys that we have been seeing have been suggesting that we were going to see at least a mid-50s print, but we saw a print around that 53 mark, and that was much worse than what the market was expecting. Add to that the jobs picture, and that's the big thing for the US market. We've already seen we've seen quantitative easing 1, we've seen quantitative easing 2. A lot of people in the market asking, you know, what has that money done? It's provided a short-term lift in terms of economic growth in the US, but where is the jobs creation? We've now seen 7 consecutive weeks with that initial jobless claims above that 400,000 mark. We're seeing that non-farm payroll numbers out on Friday. We know that without jobs, without the housing market, well, where are the consumers going to come from? Where's the retail spending going to come from? The US economy very much dependent on the consumer, 70% of their GDP. So a lot of question marks around US growth, and question marks around whether we're going to see a double dip in terms of the US economy.
Julie, those question marks that you raise in the US, and also, I mean, the swag of uncertainty that we've got coming out of Europe, I mean, does this really make any rally in global equity markets only, you know, basically just waiting for the next piece of bad news to see rallies downtrodden and just keep us in this range?
Well, the unusual thing about the markets, especially the US market, has been its ability to ignore the bad news. And I think yesterday on the US market, what we saw was an inflection point where markets suddenly started to factor in all that bad news that we've been seeing. In fact, if you have a look at the US market and strip out yesterday's performance, the US market's only been down just over 3% in this correction. Compare that to the Australian market, and our correction has been 7.9%, and compare that to the correction that we've seen in China, a new low in that correction today, with a fall of 12.3% over the last 7 weeks. So obviously markets very jittery and starting to really price in the possibility of slowing global growth, driven by the news out of the US. Of course, the Eurozone's a bit of a basket case, and China slowing down as well. China's still seeing very strong amounts of growth, but a lot of concern around China, and especially those special purpose financing vehicles the quality of loans in China very much coming to the forefront. Yesterday we heard that we were going to see local government debt about 2 to 3 trillion yuan worth being shifted out. That's going to have an impact in terms of the big banks over there, and they'll probably have to take a hit. But a lot of people pointing to a larger problem in China in terms of the quality of the loans in the banking system over there, because of the huge amount of stimulus that got pumped through China in 2009 and the huge amounts of cash that got pumped through. So concern over China, concern over Europe, concern over the US, very much at the forefront of markets, and technicals very much in the picture this week for Australian traders.
There's a lot of concern.